When Charlie Munger was 53 years old, he made 32 times his money in under 2 years on a single investment. And then he spent the rest of his life calling it one of his biggest mistakes. 1977. Somewhere in California, Charlie Munger's phone rings. It's his broker. Got an opportunity for you, the broker says. 300 shares of Belridge Oil at $115 each. Charlie already knows the numbers. He's done the research. Belridge's market cap is sitting at about $110 million. But here's what most people aren't seeing. The company owns land with 376 million barrels of oil in the ground. At current oil prices hovering between $5 and $6 per barrel, that's a liquidation value of $1.88 billion. The math is absurd. He's staring at a company trading at 1/17th of its true asset value. The downside, essentially zero. Oil isn't disappearing from those fields. The upside, enormous. Someone's going to figure this out eventually. Years later, at a Berkshire Hathaway shareholder meeting, Charlie would put it bluntly. An idiot could have told me there was no possibility of losing money and a large possibility of making money, so he buys the 300 shares. Total investment, $34,500. 2 years pass. It's 1979 now. Shell Oil figures out exactly what Charlie already knew. They acquire Belridge Oil. Charlie's 300 shares are now worth approximately $1.1 million, a 32 times return in under 2 years. Most people would frame this as a legendary win. Charlie Munger frames it as one of the biggest failures of his entire investing career, not because he lost money, because he didn't buy more. I'm Michael, and welcome to The Wisdom Investor, Charlie Munger. Today we're diving into one of the most fascinating investment stories in Charlie Munger's entire career. Not because it's a story about losing money, not because it's a cautionary tale about risk, but because it's a story about what happens when you're absolutely right about an investment and still manage to make a catastrophic mistake. And I've spent the last week obsessing over this story because it reveals something fundamental about how the greatest investors in history actually think about opportunity cost, position sizing, and the difference between not losing money and actually maximizing the opportunities in front of you. So let me take you back to 1977. Charlie Munger is 53 years old. He's already closed his investment partnership, Wheeler, Munger and Company, which ran from 1962 to 1975 and generated returns of 19.8% annually compared to just 5% for the Dow Jones over the same period. According to Warren Buffett's essay, The Super Investors of Graham and Doddsville, written in 1984, Charlie's track record was absolutely extraordinary. But here's the thing. By 1977, Charlie isn't running a partnership anymore. He's essentially managing his own money and serving as vice chairman of Berkshire Hathaway, though he won't officially join the board until 1978. He's reading voraciously, thinking across disciplines, building what he calls his latticework of mental models, and he's looking for opportunities that meet his incredibly high standards. Now I want you to understand something about how Charlie Munger approached investing by this point in his career. He wasn't following Benjamin Graham's cigar butt approach anymore. Buying cheap companies trading below book value and hopping for a small profit. Charlie had evolved beyond that. He was looking for what he called no-brainer situations. Investments where the downside was essentially zero and the upside was substantial. And Belridge Oil was exactly that kind of opportunity. So here's what actually happened. Charlie gets a call from his broker. There's a relatively small oil company called Belridge Oil and shares are available. Now, most investors would look at the stock price, maybe glance at some financial ratios and make a decision. Charlie Munger doesn't work that way. He goes deep. He starts researching. And what he discovers is wild. Belridge Oil has a market capitalization of about $110 million. That's what the entire company is worth according to the stock market. But when Charlie digs into the actual assets, when he looks at the oil reserves they own, when he does the basic arithmetic that apparently nobody else is bothering to do, he finds something shocking. The company owns land containing 376 million barrels of proven oil reserves, not speculative reserves, not maybe there's oil here reserves, proven, oil that's definitely in the ground and can be extracted, and oil prices at that time are trading around $5 to $6 per barrel. So let me walk you through Charlie's math here because this is important. 376 million barrels times $5 per barrel equals $1.88 billion in liquidation value. That's the absolute floor. That's if you just extracted all the oil and sold it at current prices with zero markup, zero profit margin, zero anything. The company is trading at $110 million. The oil in the ground is worth $1.88 billion. Think about that ratio for a second. The market is valuing this company at 1/17th of just its raw asset value, not even counting the infrastructure, the expertise, the extraction capabilities, the future potential, just the oil sitting in the ground. Charlie looks at this and sees exactly what any rational person should see. There is no possibility of losing money here. Even if oil prices drop, which seems unlikely given the geopolitical situation in the late 70s, even if the extraction costs are higher than expected, even if everything goes wrong, the downside is tiny. You're buying dollar bills for 6 cents. And the upside? Enormous, because eventually someone is going to notice this discrepancy. Eventually, a major oil company is going to realize they can buy Belridge Oil for $110 million and get access to $1.88 billion worth of oil. It's not a question of if, it's a question of when. So Charlie makes his decision. He tells his broker to buy 300 shares at $115 each. Total investment, $34,500. Now I want you to pause here and think about what just happened, because this is where the story gets really interesting. Charlie Munger, a man who has already proven himself as one of the best investors of his generation, who has access to capital, who has the conviction to see this as a no-brainer opportunity, buys 300 shares, $34,500. Not 3,000 shares, not 30,000 shares, 300. And here's what I've come to realize after studying this story obsessively. This is the most human moment in Charlie Munger's entire investing career, because what he did is exactly what most of us do when we find a good opportunity. We dip our toe in, we take a position that feels comfortable, we buy enough to participate but not so much that it feels scary. Charlie knew the analysis was sound, he knew the downside was essentially zero, he knew the upside was massive, and he still only bought 300 shares. 2 years go by, it's 1979 now, and exactly what Charlie predicted would happen happens. Shell Oil notices the exact same thing Charlie noticed. They look at Belridge Oil's asset value, they do the math, and they make an acquisition offer. The deal goes through, and when the dust settles, Charlie's 300 shares are worth approximately $1.1 million. He turned $34,500 into $1.1 million in under 2 years. That's a 32 times return, 32x. Most people would throw a party. Most people would tell this story at every dinner party for the rest of their lives. Charlie Munger does something different. He stands up at a Berkshire Hathaway shareholder meeting years later and tells thousands of people that this was one of his biggest mistakes. Let me read you his exact words from the 2001 shareholder meeting. When I was somewhat younger, I was offered 300 shares of Belridge Oil. An idiot could have told me there was no possibility of losing money and a large possibility of making money. I bought it. Notice the way he phrases that. An idiot could have told me. He's not saying he was smart to see the opportunity. He's saying the opportunity was so obvious that even an idiot couldn't miss it. And then comes the devastating part. I bought it. Not I backed up the truck, not I made it a significant position, just I bought it. And then he continues. If he had bought more shares, if he had actually sized the position proportional to his conviction and the mathematical certainty of the opportunity, he could have made tens of millions of dollars instead of just $1 million. The opportunity cost of his caution cost him exponentially more than the investment itself made him. Now, here's where this gets really fascinating for me. Because Charlie Munger is famous for his mental models, right? He's the guy who talks about building a latticework of frameworks from multiple disciplines. He's the guy who says you need maybe 80 to 90 key models to carry 95% of the freight of good decision-making. And yet here, in one of the clearest investment opportunities of his entire life, he falls into a trap that goes against multiple models he himself advocates for. Let me break down exactly what happened from a mental model's perspective, because I think this is where the real lesson lives. First, there's the concept of circle of competence. Charlie talks about this constantly. Only invest in things you deeply understand. Know the boundaries of your knowledge, and if something falls outside your circle, acknowledge that and move on. Belridge Oil was absolutely within Charlie's circle of competence by 1977. He understood asset valuation. He understood commodity prices. He understood how major oil companies think about acquisitions. This was not outside his expertise. Second, there's inversion. One of Charlie's most famous mental models. Think problems backward. Instead of asking, how do I make money on this? Ask, how could I possibly lose money on this? And when Charlie inverted the Belridge Oil investment, when he thought about all the ways it could go wrong, he came up empty. Oil prices would have to collapse. The reserves would have to be fraudulent. Some catastrophic event would have to occur. The probability of loss was essentially zero. Third, there's the Kelly criterion. This is a mathematical formula for position sizing based on your edge and the probability of success. It comes from information theory, and Charlie Munger loves applying mathematical frameworks to investing. The Kelly criterion basically says, when you have a high probability edge, you should size your position proportionally to that edge. When the probability of success is extremely high and the payoff is substantial, you should bet big. Charlie had a massive edge. He had done analysis that apparently nobody else in the market had bothered to do. He had identified a 17-to-1 value gap. And according to Kelly, according to the mathematics of optimal position sizing, he should have made this a huge position. Not a $34,500 position, a several million-dollar position. But he didn't. So what happened? Why did one of history's greatest investors, someone who literally wrote the book on mental models and rational decision-making, make what he himself calls a catastrophic mistake? And I've thought about this a lot. I've read everything I can find about this investment, and here's what I think happened. This is my interpretation based on studying Charlie's career and his psychological frameworks, but I think there are three things at play here. First, there's the psychological comfort zone. Even when we know something intellectually, even when the math is clear, there's this emotional governor that kicks in. It's related to loss aversion, this idea from behavioral economics that the pain of losing feels about twice as strong as the pleasure of gaining. Even though Charlie had inverted the problem and determined he couldn't lose, there's still this gut-level discomfort with making a massive bet. It just feels wrong to put a huge percentage of your net worth into 300 shares of a small oil company, even when the analysis says it's safe. Second, there's the opportunity cost blindness that affects even the smartest people. We're really good at calculating downside risk. We obsess over it. We imagine all the ways we could lose money. But we're surprisingly bad at calculating upside opportunity cost, the cost of not acting aggressively enough, the cost of being right but being too small. Charlie saw the downside clearly, essentially zero, but I don't think he fully appreciated the upside opportunity cost of not buying more until after the fact. And third, and this is something Charlie talks about in his later years, there's this idea of deserving what you want. He has this principle: you don't get what you want in life, you get what you deserve based on the preparation and action you take. And I think in 1977, Charlie analyzed Belridge Oil correctly. He deserved to make money on it, but he didn't act proportional to his conviction. He didn't fully commit to the opportunity in front of him. And therefore, he didn't fully deserve the maximum possible return. Now, here's where this story gets even more interesting, because Charlie doesn't just tell this story once and move on. He brings it up repeatedly at Berkshire Hathaway shareholder meetings. He uses it as a teaching example. He rubs his own nose in his mistake, and there's a reason for that. Charlie has this philosophy about mistakes that I find absolutely fascinating. He says, I like people admitting they were complete stupid horses' asses. I know I'll perform better if I rub my nose in my mistakes. This is inversion applied to learning. Most people try to forget their mistakes. They rationalize them. They minimize them. Charlie does the opposite. He amplifies them. He makes them painful, because the pain plus reflection equals progress. And the Belridge Oil story becomes this permanent part of Charlie's mental framework. It's his go-to example of what happens when you're right about the analysis but wrong about the action. When you correctly identify an opportunity but fail to size it appropriately. And you can see how this lesson influenced his later career. If you look at the major investments Berkshire Hathaway made after the late 70s, after the Belridge Oil lesson, you see a pattern. When they identify quality businesses with minimal downside and substantial upside, they go big, they make it meaningful. Think about Coca-Cola in 1988. When Warren Buffett, heavily influenced by Charlie's philosophy, decided Coca-Cola was a quality business with a durable competitive moat, they didn't buy a token position. They eventually invested over $1 billion and made it one of their largest holdings. That's the post-Belridge mindset. When you have high conviction in a quality opportunity, make it meaningful. Or think about their approach to See's Candies back in 1972. Charlie convinced Warren to pay what seemed like an expensive price, $25 million for a company earning about $4 million annually. That violated traditional Benjamin Graham value investing principles. But Charlie saw the brand power, the pricing power, the quality of the business. And because he had conviction, because he understood it deeply, they sized it meaningfully. Not token, meaningful. And See's Candies has generated over $2 billion in cumulative profit for Berkshire Hathaway since that acquisition. $2 billion from a $25 million investment, because they went big when they had conviction. Now I want to talk about how this applies to your life, because the Belridge Oil story isn't just an investing lesson. It's a framework for thinking about how we approach opportunities in general. Think about your own career for a second. How many times have you identified an opportunity that was clearly valuable, clearly low risk, clearly high upside, and you dipped your toe and instead of fully committing, maybe it was a career move, maybe it was starting a business, maybe it was learning a skill that you knew would compound over time. You knew it was right, you did the analysis, you understood the downside was minimal, but you hedged, you kept your options open, you took the safe path instead of the optimal path. And here's what Charlie's story teaches us. The cost of that hedging, the opportunity cost of not fully committing when you have genuine conviction, is often exponentially larger than any downside risk you were trying to avoid. Charlie uses this phrase in his later writings and speeches. Sit on your ass investing. He says, investing is where you find a few great companies and then sit on your ass. But what he means by that is when you find those few great opportunities, when you do the deep analysis and determine something is genuinely excellent, you don't trade in and out, you don't market time, you commit fully and you hold. But there's an implicit corollary to that principle. You have to actually make those few opportunities meaningful. You have to size them appropriately. Otherwise, you're sitting on your ass with a position that's too small to matter. And this connects to another one of Charlie's core principles, the three-basket approach. He says we have three baskets for investing. First basket, yes. Second basket, no. Third basket, too tough to understand. Most things should go in the no basket or the too tough to understand basket. But when something lands in the yes basket, when it clearly meets your criteria, when the analysis is sound and the opportunity is real, you need to act accordingly. Belridge Oil was clearly in Charlie's yes basket. He had done the work, he had the conviction, but he acted like it was in the maybe basket, like it was a speculation he was testing rather than a conviction he was backing. Let me tell you what I think the real lesson is here, and this is my interpretation after spending way too much time thinking about this story. The lesson isn't about finding great opportunities. Charlie was excellent at that. The lesson is about aligning your position size with your conviction level. If you truly believe something is a no-brainer, if you've done the analysis and determined the downside is essentially zero and the upside is substantial, and it's within your circle of competence, then betting small is actually irrational. You're saying with your analysis that this is obvious, and then saying with your actions that you're not sure. There's a mismatch between thinking and doing. And that mismatch cost Charlie Munger millions of dollars in opportunity cost. He made $1.1 million, which sounds incredible. But he should have made 10 or 20 times that. The difference between those two outcomes is the cost of not aligning action with conviction. Now I want to be really clear about something. This is not advice to bet big on speculative ideas. This is not about YOLO-ing your life savings into random opportunities. That's the opposite of what Charlie teaches. What Charlie teaches is deep analysis, understanding your circle of competence, calculating downside risk, and then when you genuinely have a high conviction, low risk, high upside opportunity, acting proportionally to that conviction. Most opportunities should get a no, most ideas should be rejected. But when you find that rare yes, when you find that genuine no-brainer within your circle of competence, the lesson from Belridge Oil is don't hedge, don't dip your toe in, make it meaningful. And here's where Charlie's intellectual honesty comes through. At that 2001 Berkshire Hathaway shareholder meeting, he doesn't sugarcoat this. He doesn't say, well, I made good money so it worked out fine. He calls it what it is, a mistake, a failure to act on conviction, a gap between knowing and doing. And I find that level of honesty refreshing and instructive. Because most people, when they make money on an investment, even if they should have made more, they frame it as a win. They pat themselves on the back. Charlie frames it as a failure because he knows the counterfactual matters. What could have been matters just as much as what was. This connects to his broader philosophy about inversion and thinking backward from outcomes. If you only evaluate your decisions based on what happened, you're missing half the picture. You need to evaluate based on what could have happened given the information you had at the time. And when Charlie evaluates Belridge Oil honestly, When he thinks about what he knew in 1977 and what he should have done given that knowledge, the conclusion is clear. He should have bought a lot more. Now there's another dimension to this story that I find fascinating. It's about the evolution of Charlie's thinking over his career. If you look at his early investment partnership days in the 60s and 70s, Charlie was influenced by Benjamin Graham's value investing framework. Graham's approach was all about finding cheap stocks trading below intrinsic value, buying them, waiting for the price to converge with value, and then selling and moving on to the next opportunity. But Charlie evolved beyond that. He started incorporating ideas from other disciplines: psychology, biology, physics, engineering, and he developed this more sophisticated framework where quality and durability of competitive advantage mattered more than just getting a cheap price. And Belridge Oil sits right in that transition period. It's 1977. Charlie has already influenced Warren Buffett to move away from pure Graham-style investing. They've already bought See's Candies in '72, paying what seemed like a high price but recognizing the quality and pricing power. They're starting to think about wonderful companies at fair prices rather than fair companies at wonderful prices. But Belridge Oil is interesting because it was actually both. It was a wonderful asset at an absurdly wonderful price. It combined Graham-style quantitative cheapness with clear fundamental value. It should have been the easiest decision of Charlie's career. And yet he still hesitated, still sized it too small, and I think that hesitation reveals something deeply human. Even when our intellectual frameworks are sound, even when we know what we should do, there's this psychological friction that holds us back. Fear, caution, the weight of potentially being wrong even when everything says you're right. Charlie talks about this in another context. He says the first rule of a happy life is low expectations. But when it comes to investing, when it comes to seizing opportunities, low expectations are deadly. You need high standards for what counts as an opportunity, yes. But when something meets those high standards, you need proportionally high action. Otherwise, your high standards are just an intellectual exercise that doesn't translate to results. Let me give you another example from Charlie's career that illustrates the contrast. In the early days of Berkshire Hathaway, when they were still primarily a textile company, Warren and Charlie made the decision to completely pivot away from textiles and toward insurance and other businesses. That was a massive strategic decision. They were essentially saying, we're going to wind down the core business and completely transform this company. That required conviction. That required betting big on a new direction, and they did it. They didn't half commit to insurance while keeping one foot in textiles. They went all in on the transformation. And that decision, that willingness to fully commit when they had conviction, is a huge part of why Berkshire Hathaway became what it is today. So why the difference? Why did Charlie fully commit to the Berkshire transformation but only partially commit to Belridge Oil? And I think the answer is that one was a long-term strategic vision and the other was a short-term tactical investment. And psychologically, we find it easier to commit to big strategic visions than to tactical executions. Strategic visions feel important and worthy of full commitment. Tactical investments feel like gambling even when the math says they're not. But Charlie's lesson from Belridge Oil is that the math should matter more than the feeling. When you've done the analysis and the opportunity is real and quantifiable, the fact that it feels like a short-term tactical opportunity shouldn't make you size it smaller. The certainty of the outcome is what should determine the size, not the time frame or the narrative framing. Now, as I'm wrapping up this deep dive, I want to emphasize something that I think gets lost in a lot of investment education. Charlie Munger is famous for his extraordinary returns. His investment partnership averaged 19.8% annually over 13 years. His contributions to Berkshire Hathaway's philosophy helped generate returns of 19.9% annually from 1965 to 2024, turning a $43 investment into over $2.4 million. But Charlie's legacy isn't really about the percentage returns. It's about the thinking frameworks that generated those returns. And more importantly, it's about his willingness to learn from mistakes even when those mistakes still made money. Belridge Oil made him $1.1 million. By any normal standard, that's a huge success. But Charlie doesn't judge by normal standards. He judges by the standard of did I think clearly and act rationally given what I knew. And by that standard, Belridge Oil was a failure, not because the outcome was bad, but because the process was flawed. He knew it was a no-brainer. He should have acted like it was a no-brainer. The gap between those two things, between knowing and doing, is the mistake. And I think that's why he kept bringing up this story at shareholder meetings years and decades later. Not because he was beating himself up, not because he couldn't let it go, but because it's such a clear, quantifiable example of a principle that applies everywhere. When you have genuine conviction based on sound analysis within your circle of competence, size your commitment proportionally to that conviction. Don't let psychological comfort zones override mathematical certainty. Don't let fear of being wrong prevent you from being sufficiently right. Don't make the mistake of dipping your toe in when you should be backing up the truck. So here's what I want you to take away from this. Charlie Munger made 32 times his money on Belridge Oil in under 2 years, and he considers it one of the biggest mistakes of his investing career because he didn't make it a big enough position. The opportunity cost of his caution cost him millions of dollars that were sitting right there in front of him, backed by clear mathematical analysis showing minimal risk and massive upside. That 1977 investment wasn't about getting lucky. It was about doing the deep analytical work to identify asymmetric opportunities and then, and this is the critical part, acting proportionally to the strength of your conviction. Charlie did the first part brilliantly. He failed at the second part, and he's spent decades making sure everyone learns from that failure. Now I want to hear from you. Have you ever identified a clear opportunity, knew it was right, and still hedged instead of fully committing? What held you back? Was it fear of being wrong, psychological comfort zones, or something else? Drop a comment below and let's discuss. If you found this valuable, hit that like button and share this episode with someone who's interested in investing and decision-making frameworks. It really helps us reach more people who can benefit from Charlie's wisdom. We release new Charlie Munger episodes every day on the Wisdom Investor, so subscribe and turn on notifications so you never miss an episode. I'm Michael, this is the Wisdom Investor, and I'll see you in the next one.